Hi, welcome to lesson 7, the psychology of winning traders, the most important lesson in this entire trading course. Why? Because remember, what makes a successful trader are three factors. The first is having a system that gives you an edge in the market, that has a positive expectancy, that tells you the entry and exit rules. The second is about position sizing, ensuring that you risk a small percentage of your capital, ensuring that your average win is more than your average loss. But 60% of your success, or more for that matter, comes down to your psychological discipline to be able to follow the system consistently, to be able to follow your entry and exit rules without deviation. And many times, many people can't follow these rules because of emotions that come up, fear, greed, that causes them to change their rules halfway, or causes them to not follow their rules, or opinions or rumors that they hear in the market. And that's why most traders fail. In this book known as Market Wizards, Jack Schwager interviewed some of the best traders in the world, people who made 50, 100% returns every single year. And he wanted to find what were their secrets. And what he found was not their secret, was their strategy or system. Because they all use completely different systems. For example, one trader would use purely technical analysis, chart reading, and no fundamentals. Another person would use pure fundamentals and no charts. Another person would use Bollinger Bands and price action patterns. Another person would say, Bollinger Bands don't work, they use MACD, right? So he said, what? They all use completely different entry and exit rules. So what makes them all consistently successful? And the answer is they all had the right psychology in trading. At the same time, I can tell you that you can attend a seminar or be mentored by $1 million trader. He can teach you his exact system and strategy, but you will still lose money and you will fail if you do not have his psychology. So many people spend most of their time looking for the right strategy, looking for the right indicator to use or the right technique. And they are really going the wrong direction because what they failed to focus on was adopting the right mindset, to think differently from the crowd. So we're going to be focusing on that in this lesson, right? So psychology is more important than strategy. And winning traders are different. Not because, again, of the indicators or technical knowledge they have, although it is important, but not the most important thing. But what makes them different is the mindset they have towards trading. Again, the best strategies and indicators will not help you succeed if you have the wrong mindset towards trading. Many people go in search for this holy grail, especially people who are in what we call the beginner cycle, right? They go from book to book, seminar to seminar, looking for the best technique that will help them to win all the time. But you know what? We know one thing, that does a special strategy or indicator exist that can predict the market and win all the time? Does it exist? No. Right? And until you figure that out, you'll never succeed. So the secret to trading success does not lie in an amazing theory or indicator. The secret lies in the mind of the trader. And let me share with you one of the best quotes by Jesse Livermore, one of the best traders that ever lived. And Jesse Livermore said this. He said, "The answers to the question of successful trading are to be found in the trader's own mind. Those who seek answers from the latest invention of trading systems or tips will not find the answers because they have not understood the question." Wow, that sounds deep, right? But basically, you have to know where to focus on to succeed, and that's psychology. So what is the psychology of winning traders? The first thing is having absolute discipline. What does discipline mean? Discipline means the ability to trade consistently according to your own entry and exit rules that have been predetermined. For example, if you have an entry rule that says that when a 50 moving average crosses the 150 you buy, you got to do that consistently. If your trading system says that if you get a bullish pin bar below the lower Bollinger Bands, you buy, you follow that consistently. All right, you got to do that consistently. And you never listen to rumors, opinions of other people, and never buy and sell based on emotions. And you have to have the discipline to stick to your strategy through the wins and losses. So remember that no matter how good a strategy is, that has got a 60% or 70% win rate, it will go through losses. There will be times when they are losing streaks. You may have 3 or 4, even 10 losses in a row, right? And most people, what happens when they go through losses? What happens is that they start to have doubt. They go, oh, is it working? Maybe my strategy is not working, right? And it's human nature to want to avoid pain. So what do? There's this overwhelming temptation to start to change their strategy. Or maybe let me add a new indicator in. Maybe let me listen to this guru who seems to win all the time. And the moment you start to intervene in your system, change your rules, or not follow your rules, I guarantee you that your system will fail to have a positive expectancy. And in the end, you will lose money. And avoid listening to the opinions of experts who can predict the market based on insights or news. So I can tell you that as a winning trader, you have to ignore all the opinions of other people, right? When you hear people on CNBC or the news and they say that the S&P is going to go down this year, it's going to go up this year, or it's going to crash, you've got to ignore all these things. Why? Because no one can predict the future. All you got to do is to follow your strategy in your system and you'll make money. Let me give you a simple example. The year is 2016, beginning of the year, right? And let's imagine you have a strategy that says that on an uptrend you're going to buy. And an uptrend is determined by the 50 crossing above the 150 moving average. Let's imagine that is your strategy, okay? And what happens is at the beginning of the year, you happen to read the news. And it says over here, on the 15th of January, it says that a recession worse than 2008 is coming. Woo, all right? And on that same week, on the 13th of January, it says that S&P will plunge 75% on China deflation. Now, what happens when you read all these news, right? You start to get fearful, like, oh my God, what if they are right? What if the market's going to collapse? You know, you start to have doubt, start to have uncertainty, all right? And sure enough, when January starts, okay, and you see this 50 crossing over 150 signal, and you're supposed to buy what you say, you know, maybe I should not listen to my signal because it's going to have a crash. And by not following the signal, what happened? At the end of the year, okay, the S&P ended up about 10%. So you would have missed that huge profit if you had listened to those opinions, rumors, and news. Okay, so you gotta have the discipline to follow your strategy through the wins and losses, through all these news and rumors. And that's the key to success. Alright, so the next factor in having the winning psychology is to think statistically. So you gotta think like the owner of a casino, where you're not concerned about the specific bets, whether you win or lose certain bets, because you know that if you have a positive expectancy, you will always win at the end of the day. So you've got to think statistically over a large number of trades and not just one or two or a few trades. Because remember that a winning strategy will have wins as well as losses. And there are times that losses and wins can come in a row, of even 5 to 10 losses or wins in a row. So when you get a series of winning trades, don't get greedy and start to increase your bet size or increase your risk. And when you get greedy, don't start taking trades too easily, which are low quality. Because the moment you do that, it would screw up your system and cause you to lose in the long term. At the same time, if you get a series of losses, don't start to get fearful and a fear taking the next trade, even though there's a valid signal. Or you start to reduce your risk, or you start to want to change your indicator to avoid those losses. And again, the moment you do that, your system no longer has a positive expectancy. Remember that every trade outcome is statistically insignificant. Every trade outcome is random by itself. It's kind of like tossing a coin, right? And a good trade, one where you follow all the rules, can still end up as a loss. Okay? So focus on following the rules consistently and not on the outcome of each trade per se. As long as you have a statistical edge, as long as you have a strategy that gives you an edge and your average win is more than your average loss, remember that you will always be profitable at the end of the day over many trades. You got to think statistically. The next thing is patience. All great traders are extremely patient. In other words, only trade when you see a high probability opportunity where all your entry rules are met. Okay, many traders who are new, they tend to be trigger happy, and every single day they're looking for trades. And if they can't find a trade that fits their entry rules, they may get impatient and say, "Oh, what the heck? I'll just trade it anyway," because they want some action, they want to have some fun. I'm here to tell you this: if you want fun and action, go to Disneyland, go to Universal Studios. Right? Trading is not supposed to be fun and exciting. Trading is supposed to be boring and mundane. Okay? If it's exciting, something's wrong. So remember that if the rules tell you that there's nothing to enter, don't enter. Okay? In trading, not doing something is doing something. And it's better to not trade than to take a low quality trade. So you're going to have patience. The next key is to focus on what is happening and not why something is happening in the markets. You know, oftentimes newbies, right? For example, they see a long setup and they go in and it hits their stop loss. And they start to wonder, you know, why did it hit my stop loss? What happened? Was it because something that Trump said? Was it because they increased interest rates? And they always want to assign blame or a reason why the market behaved a certain way. At the same time, maybe they went into a trade and it hit their profit target and say, wow, fantastic, you know, how come it won? And they attempt to find a reason why it won. And this is a complete waste of time as a trader. Remember that price movements are not caused by public news, although it seems that way, right? I repeat that. Price movements are not caused by news. Price movements are caused by the market's interpretation of the news. In the first place, you can never predict the news. You can't predict whether Trump would win or Hillary would win, whether Brexit would prevail or not prevail when the vote was counted. And even if you could predict the outcome of the news, you can't predict how the market will interpret the news. So sometimes the same news can cause the market to go up in one situation and cause the market to go down in another situation. And whether the market goes up or down, you find that analysts all over the world will always find an explanation to explain why the market moved this way. And it's a complete waste of time for a trader to do that. So just focus on the existing price action and not ask why something has happened. Okay? Next, the next key is do not ever attempt to predict the future. All right. For example, if you put in a trade, don't say, okay, this trade is going to win. It's going to go up definitely, right? Or, you know, this year I know the S&P is going to go down. I know that, right? Why shouldn't you predict the future? Well, in the first place, it is impossible to remember that. All price movements are driven by crowd psychology. Okay? And avoid listening to experts who give predictions about the future. At the beginning of every year, you always have experts who give market outlooks and forecasts. And that's interesting to listen to for an entertainment's perspective. But you should never base your investment or trading decisions based on opinions or predictions, even your own. They should be based purely on the predetermined entry and exit rules of your trading system. So always trade based on the current trend or reversal in trend. And don't predict when the trend is going to reverse because you can never predict that. Predicting the future tends to cloud our judgment and makes us less willing to take losses because of the ego's need to be right. See, many beginners, when they place a trade, right, and they say, you know, it's gonna win, it's gonna go up. Now, what happens if it doesn't go up? It doesn't win. They feel bad, they feel disappointed, and they get emotional about it. They get upset, right? Or worse still, if they say it's gonna go up, I predict it's gonna go up, and it goes down. What happens? They say, you know what, the market's wrong, I'm right. And what they do is they refuse to take the loss. They would remove their stop loss, or they will lower their stop loss to give the trade more room to move. And that, my friend, will lead to absolute disaster in your account. So in trading, it's not about being right or wrong. It's about making money or losing money. Okay? So whenever I place a trade, I always tell myself that I've got no idea whether this will be a winning trade or this will be a losing trade. I've got no idea, and I don't care. Because I know in the long run, my wins will be more than my losses. So I emotionally detach myself from any single trade outcome and have no expectations when I place a trade. The next thing is about risk management. I've talked about this in the earlier video. Let me reinforce it over here. Remember that there's no trade that's guaranteed to win. There is no sure win trade or sure win investment. So as a result, we always risk a small percentage of our capital. Whether it's 1% to a maximum of 3%. And once you decide on your risk per trade, you have to stick to it consistently. You can't say, hey, I feel good about this trade, I'm going to risk 3% or 10%. I don't feel too good about this trade, let me risk 1%, right? Because if you do that, again, your system will not have a positive expectancy. Finally, one of the most important qualities of winning traders is they have a very high level of confidence. Now, confidence in trading is very different from what many people think. Okay, many people think that if I'm confident, it means that I place this trade, I know it's going to go up. I'm confident of that. Now, that is the wrong kind of confidence. Because like I mentioned, if you have confidence in a particular trade, okay, and it doesn't go your way, you get disappointed, you get upset, and it smashes your confidence if it fails or if it loses, which I can tell you 50% of the time or 40% of the time, you're going to get a losing trade. So that is really damaging to your psychology. So the confidence does not come on a trade by trade basis. But winning traders have confidence in their trading system. They've got confidence that their system has a positive expectancy. That means that they know that any single trade could be a win or loss. But if I trade over a large sample of trades, like a casino, I will always win in the end. That's where the confidence comes from. So if you know that you will always win in the end, and you get a losing trade or series of losing trades, it doesn't bother you at all. Okay? So in fact, one of the most important things of winning traders is that they believe that the game is won even before they've begun. And if you have the confidence of that, again, you will have the psychology to go through your entire system regardless of the short-term outcomes. Now let's understand the difference between good trades and bad trades, and winning trades and losing trades. Because to succeed as a trader, to make money, all you got to do is to ensure you only take good trades. Here's the difference. A good trade is a trade where you follow the rules of your predefined trading strategy that has a positive expectancy. A bad trade is a trade where you broke your own rules. In other words, you entered when the rules did not say enter. You exited when the rules did not say you should exit. So a good trade can be a winning trade or a losing trade, right? And executing good trades consistently assures that in the long term, over many trades, you will have repeatable long-term profitability. Now, what's a bad trade? A bad trade is a trade where you did not follow your rules, like I mentioned just now. Now, a bad trade can turn out to be a winning trade as well. Sometimes you don't follow your rules and you win and you make money, right? Guess what? That's called luck, okay? And if you break your rules and you make money, it may make you feel good in the short term, make you feel happy, right? But it's extremely damaging to your psychology and it will reinforce bad habits to not follow your rules in the future. And that will guarantee you that in the long term, you're not going to be profitable. So please only take good trades and avoid any kind of bad trades. Managing your emotions. So when trading, you'll be facing a whole host of emotions that's tied to money at stake in your account. Because to most people, money is a very emotional subject. And trust me, as you trade, you're going to be feeling a lot of emotions, right? Greed, fear, doubt, frustration, excitement, hope. You're going to go through a roller coaster of emotions. And to be a winning trader, you have to learn to think and act contrary to your natural instincts and emotions. Because many of our emotional patterns cause us to lose money. The human mind is wired in such a way that will cause the average person to lose money. Why? For example, as human beings, we have a need to avoid pain, to avoid being wrong, right? And we have the need to be right, we have the need to like pleasure. And this causes most people to follow the crowd and buy high and sell low and lose money, which you should be doing the opposite, right? You should be buying low and selling high. At the same time, because of the fear of being wrong, what happens? When people see that the stock is going against them, they do not want to sell to cut their losses, because they say, you know what, I don't want to take a loss, so they avoid the loss by not taking the loss until the loss becomes really huge. So in the end, they have huge losses. And once they make a bit of money, they want to take some pleasure because they like to make money, and they sell. So it causes people to get what? Big losses and small gains, which is the opposite of profitable trading. So in this lesson, I'm going to teach you how to be conscious of your emotional patterns. Because once you're conscious of them, you can overcome them. And one of the best ways to trade very unemotionally, to detach emotionally, is to trade at a level of capital and risk where having a few trades does not hurt you emotionally, right? I always like to joke that if every morning you wake up, for example, and rush downstairs and check your account and say, oh my God, did I make money or lose money? Or you're constantly checking your account, you're trading with too much risk, or you have too much capital beyond your emotional threshold. The moment you get very emotional, you will definitely lose money because you don't think objectively. So you're going to have a small risk such that even with 5 or 10 losing trades, it doesn't affect you emotionally. And that's how you trade logically and profitably. So let's take a look at some very common emotions that's going to affect you. The first thing is greed. Okay? Trust me, you're going to get greedy at times. And greed may cause you to raise your profit targets too high. Or greed may cause you to not take profits when you're supposed to take profits. And you stay in the trade too long, and this causes potential winning trades to become losing trades. There's an old Wall Street saying, bulls make money, bears make money, but pigs always get slaughtered, right? Pigs are greedy, right? So let's look at an example. On the left, I've got a chart where, for example, I place a buy order over here, and I've got a profit target over there at 2R. Okay, so let's imagine your rule says that you take profits at 2R. That's your rule. And sure enough, you place a buy, and the price goes up, and it hits your profit target, and you get 2R. You get 2R profit, right? Now what happens after you exit with your profit? The price proceeds to go a lot higher, right? Now to most people, how would they feel? Regret. Damn it, I shouldn't have taken profit so fast. I should have taken it later. I missed out. They feel they were shortchanged, right? So they start to get greedy and say, next time I will not take profits at 2R. I'll take it at 4R. Or if it's going to hit my profit target, I'm going to raise my profit target. Now, guess what happens the next time? The next time, what happens is that you buy over there, and you put a profit target that's too high, right? Say over there at 4R. Sure enough, the price goes up, but before reaching 4R, it goes all the way down, and you end up losing money. A winning trade became a losing trade because you changed your rules because of greed. Okay? So that's an example. Second emotion that people feel a lot is fear. Okay? So fear can cause a lot of things, right? And one of the things is fear may cause you to take quick profits for fear of losing those profits. Now, some people think, hey, there's nothing wrong with taking a small profit. A small profit is better than no profits. Wrong. In trading, you can go broke by taking small profits. Why? Because if you take small profits, for example, like I said, the key to a trading success is to make sure your average win is more than your average loss. That's the key. So even if you're right half the time, you still make money, right? So when you lose 1R. You have to make sure that when you win more than 1R. You have to win at least 2R to have a profitable system. But the trouble is, some people, the moment they get some profits, like they get 0.5R profits, they take the profit quickly. So if you take small profits, what happens? You don't allow your winning trades to achieve their fullest profit potential of 2R or more. And by doing that, your system may no longer have a positive expectancy. Why? Because the profits on your wins are not enough to cover the the losses on your losing trades that will happen eventually. So if you take a look, for example, on the left, you can see, imagine you got a trader who gets 1, 2, 3, 4, 5, 6, 7, 8 trades. And out of 8, he's got 5 wins and 3 losses, right? That's a good win rate. He wins more than he loses. But at the end, he still loses money. Why does he lose money? Because every time he wins 0.5 R or 0.2 R. But each time he loses 1 R. So the wins can't cover the losses. You end up with a negative expectancy. So why does this happen? All right, let me give you some examples, right? So let's imagine this is your first trade. And what happens is, let's imagine you place your buy order over there, your stop loss is here, and your target profit is here. And sure enough, your target profit is 2R profit, your stop loss is minus 1R, right? As usual, okay. So let's imagine the first trade, you buy over there, it goes up, and before it reaches the profit target, what happens? It comes all the way down, hits your stop loss, and you end up with minus 1R. And you go, damn, it's a losing trade. It's okay. Next one, right? So you go for the next one. And the next one, what happens? You buy, sure enough, it goes up, and it goes to, again, maybe 1.2R. You say, yes, you know, I'm profitable, but before it reaches the profit target, boom, hits your stop loss again, bam, another loss. Okay, next trade. Say the next trade, it happens again, right? It goes up, and before it reaches the profit target, it comes down. What has just happened? You got 3 losses in a row. So you got minus 3R. Now, what do you think that does to most people? If that happened 3 times, you start to say, damn, you know, I had some profits. I had 1R in profits, and it is gone, right? So, you know, next time if I get a 1R profit, I'm going to take it. And therein lies the problem. The moment that happens, you're screwed. Okay, why? Because say the 4th trade is a winning trade. Okay, because remember, you're going to have wins and losses, right? So after 3 losses, the next few are going to be wins. You know, it's statistics, it's probability, right? But what happens now? Now you're fearful of losing what you have. Okay, so the next trade, what happens? You buy over there, your stop loss is over there, your target profit is 2R as usual, right? Now, what happens this time? This time you buy, the price goes up, and it hits that 1.2R, it starts to come down. You say, oh, I've seen this movie before. It's going to come down, going to lose what I have. Oh my God, I better sell, right? And sure enough, as it comes down, you sell quickly for fear of taking another loss, and you get 0.8R in profit. And what happens after you sell? It, boom, goes up and hits the profit target of 2R. In other words, this trade, you're supposed to get 2R, you only got 0.8R. And let's say it happens again the next time, where you take a small profit, So what happens? In the end, you take 6 trades, right, 6 trades. The first 3, you lost 3R. The next 3, you made only 0.8R. You end up losing money. If you had allowed the profit to be reached, even you get 3 losses and 3 wins, each win is 2R, you would have made money. All right, so you got to be conscious of these patterns because they will happen. Okay, now the next thing is hope. Okay, now in real life, it's good to have hope, right? You know, hope you have good health, you know, hope your kids will study hard, and hope your wife will not leave you, right? But in trading, you can never have hope. In trading, hope is for the hopeless. In trading, hope will cause you to lose everything that you have. All right, never have hope in the market. So why? Let me give you an example. So let's imagine it's the first scenario, and you place a buy order there. Your stop loss is there at, say, I don't know, $8.05, right? And what happens is the moment you buy, the price goes down, and hits your stop loss. And right as it hits your stop loss, the price then proceeds to go up and hit your potential profit target. Now, how do you feel? You feel cheated, right? Say, damn, I was right on the direction. It's just that it went down temporarily, hit my stop loss, and it went up. And you say to yourself, you know what? The next time, I'm not going to put a stop loss. The next time, I'm going to put my stop loss further away so it won't get hit. And again, the moment you do that, you've screwed yourself for the future. Because what happens the next time? The next time, You buy over there, you place a stop loss over here, and what happens after you buy, right? It goes up, and sure enough, it goes down, it goes down, goes down, and it's gonna hit the stop loss, and you say, hey, I've seen this movie before. I remember the last time it hit the stop loss, it went up higher. So you know what? I'm gonna remove my stop loss. So you move your stop loss lower down because of this hope it will come back. And sure enough, it keeps going down, doesn't come back, doesn't come back. It's gonna hit the stop loss again and say, oh my God, you know, I'm gonna lower my stop loss and give myself more room to be right. And it keeps going down, and until eventually you say, oh my God, right? So instead of losing 1 hour, you end up losing 4 to 5 hours. And that's why I know people who are right 80% of the time, but they still lose money. You know why? Because out of 10 times, they are right 8 times. The 8 times they are right, they take small profits. But the 2 times they are wrong, they have huge losses that wipe out all their profits because they have that hope and they don't take that small loss, right? They keep hoping to be right. Okay, so be conscious of all these patterns. It's really, really important. Handling winning and losing streaks. Now, if you look below, you will see a typical equity curve of a trader over 100 trades. And what you notice is, for example, you may start with $10,000 over here and grow your capital over time to say $15,000 or $20,000 over 100 trades. And if you take a look at how your capital grows, it doesn't go up in a straight line, right? It goes up and down just like the price of a stock. So remember that the overall outcome of your trading journey will not unfold linearly. It's not a straight line going up. So do not look at the trading outcomes of a certain small period and extrapolate them into the future. What does that mean? So it means that, for example, if you happen to go through a losing streak over here, a series of losses like 5 or 10 losses in a row over here, or over here, and over here, don't get freaked out. Some people, after they get 10 losses, they might go, oh my God, if this happens, keeps going on, I'm going to lose everything. And they extrapolate that to the future. At the same time, if you get a winning streak over here, where you have a series of 10 or 15 wins, don't get too excited and get carried away and say, my God, you know, if I keep this up, I'm going to be a millionaire next week. All right? And they get too excited. So in the long run, winning and losing streaks tend to even out each other. And the long run of distribution of wins and losses are what makes us profitable. Long run performance has little or nothing to do with the luck factor. So I can tell you that in the short term, when you trade, it's a bit of luck, where you may get 5 wins in a row or some bad luck, 4 losses in a row. But in the long term, it's got nothing to do with luck, because the bad and good luck will tend to even off each other. And in the long term, it's all about statistics and probability that will guarantee your success. Let me just summarize some common emotional mistakes that newbies make in trading. So be aware of it and avoid it. Okay. The first emotional mistake people make is this. They rush into new trades after experiencing a few losses in order to win back the money quickly. So after they lose money, they say, you know, I got to quickly get some new trades to make up the losses. And that's when they take poor trades or low quality trades that do not meet their rules. Another common mistake could be the opposite, where after they take a lot of losing trades, what happens? They have doubt and uncertainty in the trading strategy, and they are afraid to take the next trade, right? So the moment they want to take the next trade, their hand shakes and they go, oh. And the moment you can't take the next trade, you will not succeed. If you keep taking the next trade, eventually you will succeed. So never be paralyzed by a loss or series of losses that are inevitable at times. The next thing is to stay in a losing trade, hoping things will turn around, like what I mentioned just now. So remember, there's no hope in the market. Hope is for the hopeless, right? On a trade-by-trade basis. Next, losing traders tend to focus on short-term results and lose their perspective. So think about the big picture and think statistically. Next, losing traders fail to stick to a consistent risk per trade percentage. Like I said, for you to be profitable, you have to stick consistently to your risk per trade of 1%, for example, or 2%. Do not increase your risk when you're greedy and reduce your risk when you're fearful. Losing traders constantly change their trading systems or strategies after experiencing short-term losses. This is very common for new traders that again are in search of that holy grail. The moment their trading system hits some losses, they start to say, you know what, I'm going to change this indicator, I'm going to change this rule, and as they keep changing and going around in circles, or worse still, you know what, I'm going to trade Forex now, I'm going to trade options now, I'm going to trade futures now, I'm going to trade stocks now, and they go around in circles, never ever making money because they don't stick to a system long enough for that system to work its statistical magic in their favor. Next, losing traders tend to focus on their account balance instead of following the system. Right? They keep looking at their balance, or my money's going up, it's going down, and when that happens, you get emotional and you don't follow the system. Next, losing traders get emotionally affected by losses. Right? When they get losses or their account's not doing well, they get stressed, they get fearful, they get frustrated, they lose their confidence, and the moment that happens, guess what? They can't succeed in trading. So you got to detach emotionally in trading. Next, losing traders blame and find external reasons for their losses. I lost money because the market is bad. I lost money because the Federal Reserve increased interest rates. I lost money because Donald Trump won the election. Bullshit, okay? As long as you blame people, you will never succeed in trading because there'll always be something to blame. Next, losing traders tend to desire to take revenge on a stock, or they want to take revenge on the market after experiencing a loss. So if they bought a stock and they lost money on that stock, they say, you know what, heck, I'm going to keep holding that stock or buy that stock again until that stock makes me that money back. I got news for you. The stock doesn't know who you are. Okay, so don't get personal. Next, losing traders trade with methods that do not suit their personality. And too often, people will hear about another trader's success, out of envy or, whatever it is, and they feel compelled to copy that person. And that's when it doesn't work because you got to follow a system that fits your personality of trading. Now, on the other hand, let's take a look at the habits of successful traders. Here's a summary. Habit number 1. Successful traders always take action when there's a valid and high probability signal in their trading system. They don't let fear control their decisions and interfere with their trading. Successful traders take responsibility, learn from their mistakes, and they move on. They don't dwell on setbacks. I love the metaphor from that show, Finding Dory. That show from Finding Nemo, Finding Dory. And Dory was this fish that had a short-term memory. And she'll just go on, keep on swimming, keep on swimming, keep on swimming, right? So I find that to be a good trader, you have to be a bit like that fish. When you get, some wins or losses, it doesn't affect your psychology of taking the next trade. You just keep on swimming, keep on swimming, keep on trading, all right? With no memory of the past. Next, expect and accept losses as part of the trading game. You have to lose to win in trading. And focus on following the trading system and not, again, the immediate account equity or balance in your account. Successful traders think statistically and keep a long-term perspective. Successful traders focus on being consistent. They consistently follow the predetermined entry and exit rules and do not listen to other people. Successful traders are patient. They wait only for high probability opportunities. So remember, guys, the biggest enemy to your trading success is not the market, it's you. And a good trade is one where you followed the rules of the system and not one that necessarily led to a short-term profit. As a trader, one of the most common things you have to face is drawdowns. What are drawdowns? Drawdowns, I call them the cost of being in the trading business. A drawdown is a reduction in your account equity from a losing trade or series of losing trades, which are inevitable in trading. Because again, winning trades and losing trades can come in a row at times. And drawdowns are the main cause of psychological damage to traders and their success. So as I've said before, as you trade, your equity or your account will not go up in a straight line. They will go through ups and downs, and every time it goes down, for example, from 10 to 15,000 and from 15 grand to 12 grand, that's known as a drawdown. Here's another drawdown from 22 grand to 17 grand. So how do we deal with drawdowns psychologically to not let them affect us? Here are a few strategies that I use. The first thing is to condition your mind to accept drawdowns as being part of the trading journey, that they are the normal course of doing business. See, when I trade, I look at trading as a business. In a business, you have got sales and costs, right? For example, if you're selling clothes and you sell, for example, a dress at $100, it may cost you $50 to get the raw materials, right? So your profit is $50, and we call that your profit margin. In this case, the profit margin is 50%, which is a pretty healthy margin for business. So whenever I get a win in trading, I treat it as the sales. For example, 2R, that's my sales. And when I get a loss, I treat it as a cost of doing business minus 1R. So like I said, if you even have a win rate of 50%, that means that for every sales, you have a cost, right? So 2R minus 1R is 1R in gross profit. So again, when I look at a losing trade as a cost of business and not a bad thing, I feel great about it. I don't feel bad about it, okay? So you can't have a business with only sales and no costs. Doesn't make sense. The next thing is to not focus on the monetary value. Many people, when they have a loss, they think, I just lost $5,000, I just lost $50, I just lost $500, and they equate that to something in their life. Like they say, I've just lost an entire day's of work in a trade, or I lost a TV set, I lost an iPhone, right? You can't do that, right? So I never think in terms of dollars, I think in terms of R multiples. That a losing trade represents minus 1R. A winning trade is 2R or more. So when you think in terms of R's, you kind of like shield yourself psychologically from the money and you don't get emotional. Next thing again is to treat a small number of trade outcomes as statistically insignificant. As I keep saying that in the short term, a trade you do is random. You can't tell a win from a loss in the short term, but in the long term, it's always going to be profitable. And that's how you condition yourself. Let me end off with this quote by Bruce Lee, one of the greatest fighters that ever lived. And he said this: "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced just one kick 10,000 times." One of the things I notice about all successful traders is they tend to trade with only a single strategy, or at the very most maybe 2 strategies or 2 systems. And they do that consistently, so much so that they master those setups. Losing traders tend to trade any setup they can find. For example, they open the computer and say, hey, today there's a breakout pattern, let's buy the breakout. And then, hey, there's this dip on the uptrend, let's go and buy the dip on the uptrend. Hey, there's this divergence pattern, let's buy the divergence. Hey, it's a Bollinger Band oversold, let's short it, right? And if you keep doing all these strategies, like doing so many different kind of kicks, but you don't master anything, in the end, you can't make money consistently, right? So focus on 1 or at the very most 2 systems or strategies. Keep doing it over and over again with consistent replication, with no deviation, and you'll be extremely profitable over time. So I guarantee that, and I'll see you in the next lesson.